In today's video, I want to talk about three more economic indicators I use and follow. They are the Fed funds interest rate, the spread between the 10-year and 2-year US Treasury bonds, and the 10-year yield itself. For those of you who are new to my channel, my name is Jared Ayers. I am a CFA charter holder, and I've been investing my money for over 20 years. I have created this channel to share with you the strategies and techniques I use to outperform the market on a regular basis and basically produce outsized returns in my own portfolio. So before we jump into my usual show and tell where I show how these indicators perform versus the S&P 500 and how I look at them, I do want to cover off just a little bit of background on each of these indicators. So the Fed funds interest rate is effectively the Fed or the Federal Open Market Committee monetary policy tool that's been used forever, basically to manage the overnight interest rate that banks use to lend to one another. Now, that's not all that important. What we really need to know is that the rate at which the FOMC or the Fed sets, whether it's increasing, decreasing, or staying flat, is often an indicator about what they believe the economic outlook and current economic environment is in the economy. So it's been a long-standing indicator and one that I've found is very useful to watch. Now, the spread between the 10-year and the 2-year Treasury bonds, that one is basically a measure of the yield curve. What we're looking for there is when the 10-year yield basically falls below the 2-year bond yield. What we call that is an inverted yield curve, and that usually is an indicator that investors or people that invest in the markets are nervous about the short to medium term performance of risky assets and basically are looking for a safe haven in longer duration bonds. That demand increases the price of the bonds, which decreases their yield, and when you get a 10-year bond yield that is lower than a 2-year bond yield, that is often a lead indicator for a pending recession. So that's obviously one thing that we do want to look for. And finally, the 10-year Treasury yield in absolute terms is another one we want to watch. Generally speaking, as the 10-year yield rises, that usually is an indicator of a healthy economy. If it flips and starts to fall, especially if it starts to fall fast, then similar to the spread between the 10-year and the 2-year, that can be an indicator that people are fleeing to safety, and is something we want to watch very closely. Also, if there's a sudden change in the 10-year yield, up or down, that can also send some ripples into the markets and cause a reaction. So once again, another interesting indicator to watch. And now I will take you into how these indicators perform relative to the broader stock market and how I look at them and track these indicators for my own purposes. Okay, so as discussed, I wanted to cover off the impact or how the Fed funds interest rate tracks against the S&P 500 and also how I look at this indicator. So as you can see on the chart, you can see that during the tech bubble, interest rates rose sort of into the start of that recession, flattened off. I'm looking at the yellow line here, and then started to plunge after the Fed realized that indeed the economy was already cooling off and they needed to back off the interest rate. So you can see again that sort of tabletop formation again, this time preceding the 2008 recession. This time it happened a little bit before the recession started, and you can see that flattening off of the rate, interest rate, and then it's starting to fall off just as the market was topping out before the recession actually started. In both of those instances, you can see the rate of increase in the rate was very steep relative to the post-2008 period where obviously the rate has stayed very, very low, and only since about 2017 has it started, or I guess 2016 actually started to increase. The rate of increase hasn't really been as steep as the last two periods, but because we are coming off of a very low base, that may be something to look at and consider. So far it is still trending up. We haven't seen that tabling off of the rates, although the Fed has been threatening that indeed they do want to ease off or hold a little bit back in terms of increasing that rate too high. Of course, they need the rates to be a little bit high in order to be able to ratchet them back in the event that the economy does get too overheated. So again, something to consider. So just putting again the lines on the trend lines on the chart itself, you can see again that tabling off, and obviously the third red line to the far right where we are seeing the current rate rise, it's not nearly as steep as those first two, as I previously indicated. Next, I wanted to just to quickly cover off the spread between the 10-year and the 2-year US Treasury bonds. So this one, again, you're looking for that sort of black line there, which is the point at which the yield curve inverts. So looking at the yellow line again, or even the blue, doesn't really matter. You can see for the tech bubble correction or crash, you can see that the yield curve did invert just right at the beginning of that recession, and that just about corresponded with the top of the S&P 500 returns or pricing, I guess. And then it fell down and then came back up, of course, and continued to rise through the recession, and then topped off again at some point past that. Once again, before the 2008 recession, it dipped below that number, and then came up a little bit, then came down again. Again, it's a lead indicator, generally speaking, so in this case it definitely led the recession, but whenever that yield curve does invert, it is usually a sign that you need to be a little bit careful. As you can see, then it started to climb as the start of the recession happened, and so on and so forth, a little bit lumpy through there, and then around, I guess, 2013 it started to come down and down and down and down, and it's been coming down fairly steadily for quite a while now, but has not yet crossed that threshold. So that's really the one thing that we're looking for, or I'm looking for when I'm looking at this indicator. If it does cross that line, then that's obviously something to be very cautious of, as this has been a fairly good lead indicator in the past. Of course, you do also want to keep an eye on other indicators as well, as this won't necessarily be the only indicator to let you know that a recession is coming. You want to see the other ones performing in the same direction. So once again, just putting the trend lines or pointing out to the fact that we do have that point crossing that black line there on this indicator. Next is the US 10-year Treasury yield. Again, you can see this one is a little bit more volatile than maybe the other indicators. With the tech bubble, it came to sort of a peak at the point at which the recession started, and then came down sharply from there. It was quite high, actually, around almost 7% at its peak, and then quickly came down after that. You can see then a steady rise post-recession in towards 2008. If I put that trend line on, and then again quite a sharp decrease as we approach the recession. So those decreases, those sharp decreases, can indicate that people are fleeing to safety by buying longer duration bonds like the 10-year Treasury, indicating that there maybe are fears that the economy is not suited for risky investments at that point in time. And then looking past the 2008 recession, you can see a bit of a sharp decline there around 2011, 2012, which we did see a bit of a market correction in the S&P 500 that then reversed. The market kept going higher, and then we've sort of seen a slow and steady decline followed by pretty slow and steady upclines or increase, in that indicator. So, again, not something on its own to give you an indicator of what's going to happen, but take it into account with the other indicators. If we do see this one sharply move in either direction, we may see the market react accordingly. So it's always a good one to keep an eye on because it does drive a little bit of market behavior. So that is basically what I wanted to show you from a economic indicator perspective in terms of interest rates and treasury yields. So hopefully that was helpful. So just to recap, the Fed funds interest rate, a lagging indicator because usually the government is a little bit behind in making changes to the interest rate relative to the economy. And then of course the 10-year and 2-year treasury bond yield spread and the 10-year yield, both lead indicators, as they usually are telling of something that's going to happen possibly in the near future with respect to the larger economy and the market. So I hope again that you found this information useful. If you do have any comments or questions, please be sure to put them in the comments section. By all means, if you're not yet a subscriber to my channel, feel free to hit the subscribe button, and I look forward to seeing you back here soon.